Nexo, based in Bulgaria, halted interest payments on new deposits back in February, but appears to have avoided much of the problematic lending that doomed players like Celsius and Voyager Digital. They have, in fact, been publicly on the prowl for competitors who they could roll into their operation at hopefully bargain basement prices. But data posted to the website of an accounting firm contracted by the company to provide regular attestations on customer balances shows that the lender may have suffered from significant withdrawals, similar to those which led to trouble at its rivals. The data shows that deposits declined to $3.9 billion, down a whopping $3 billion from the $6.9 billion they reported on May 12th. In a statement to CoinDesk, a Nexo spokesperson said, quote, "At any moment, Nexo's assets under management exceed its obligations, meaning we are stable and able to provide clients with their funds at any time," end quote, which is basically just a slightly fancier way of saying that they are in fact solvent, unlike many of their competitors. George, I'm going to throw this to you first. I know you've been watching kind of these lending companies for a while now. How does this news about Nexo kind of fit into the broader sort of environment in which they're operating and which we've all been observing?
Yeah, first off, it is great to hear that they at least say that they're solvent. That's great. Can they survive an actual bank run? Who knows? The thing that I'm the most focused on with all these, I'm not going to name any particular lender or yield generating platform, but we are running into a yield issue. These users generate yield with their assets, but I would generally say that the retail focused aspect of crypto and yield generation is actually an incredibly interesting thing to watch unfold in real time as everyday people learn where the yield comes from. For example, when I grew up, I heard about interest on bank accounts and in CDs and all that jazz, but it wasn't until I was like 20 years old in my first job in finance where I learned that banks do that by lending your money out. Not because I was some dumb idiot, which I kind of am, but not because I was a dumb idiot, but because most people just don't know how that works. And financial institutions are becoming more transparent, and how this works is coming more front and center. And I'm actually here for it, right? I'm not super excited about these lending platforms that are saying, oh, I'll give you 10% interest on your USDC. Don't ask why. Because I'm excited about people asking, how. I'm excited about people asking how. How are you giving me more money on the money I gave you? Are you rehypothecating it, or are you not? I think it's really interesting to see happen in real time. Sundali, anything to add?
Yeah, no, that was great. I didn't learn that until quite late too, so I'm totally with you. But yeah, it's not unusual that the firm was hit by the broader market anxiety. Says it's stable and solvent. It sounds super confident right now. I think a big part of that was obviously because, as the article says, it managed to kind of sidestep some of the big crises and collapses recently. And it also kind of says, if you'd noticed, we had no exposure to 3AC. But here's the thing about that. How do we know for sure that that was some kind of smart move it made? It can say anything in hindsight, like, oh, we knew 3AC was a bad idea, but there's no way of knowing if it was kind of by accident or not so much by plan. We've heard crypto companies sound extremely confident before, but financials of private companies like this are not public. So I believe it's stable when they say so, and it looks that way. But I think this kind of vigilance and reporting is also very necessary going forward, especially for companies showing big ambitions and looking to take over others, and if we've learned anything from this year's event. So I just wanted to point out that was great reporting by CoinDesk there. Jen, I saw you.
Suddenly you said what I was going to say, so I'm going to let Adam have the last word.
Well,
oh no, sorry.
I was just going to say that, when you're looking at these companies, there's a kind of spectrum in terms of their risk tolerance, right? And how much. And so George mentioned a term, rehypothecation. That basically means lending out another person's asset or lending out an asset that's already been lent out for something else, right? So that's what we saw in, again, the Archegos situation. And then it's also what we've seen, in some of the other situations around here. And then others, like Voyager Digital, we talked about how Three Arrows Capital at the top of the show had been able to get really great rates and, amazing deals from lenders, and that actually encouraged them to lend more. And you look at the Voyager deal, and as far as I know, that's the largest, best deal that they were able to get, where they took basically $650 million in loans with zero collateral against it, which is just a wild decision to make as a company. So Nexo doesn't have to be amazing at what they're doing. They just have to not take really ridiculous, crazy risks, right? And so, there's a saying, I'd rather be lucky than good. I think that that's true in crypto too. I think that it's much better to be lucky than good. But if you can just not be bad, if you can just not do dumb things, then that's probably enough to get you pretty far the way. And I think that we're seeing that with Nexo compared to, to Celsius and to the other kind of worse off players out there. But I think that's all the time we have for today, guys. This is always fun.
That's been a common theme on the show this week. Don't be bad, and don't be a bad person, and do good things. I think those are some great reminders